On Friday afternoon, 11th April, I sat at my desk, sipping coffee, watching the US Producer Price Index numbers roll in. The numbers were softer than expected, but what I saw on the charts and in the news that followed gave me pause. A quiet shift, subtle but telling. It reminded me of something I said in my last video, that investors were slowly backing away from the US dollar and Treasuries, and instead, turning their attention to safe havens, the euro, the Swiss franc, the Japanese yen, and German bunds. Back then, it was just a theory, a gut feeling based on sentiment, opinions online, and a few technical clues. But Friday's market reaction changed everything. First, a quick disclaimer. This video is for educational purposes only. I am not a financial advisor, and nothing here should be taken as financial advice. What you're about to hear is my personal view, based on research, experience, and market observation. Always do your own research before making any trading or investment decisions. Welcome to Markets and Global Trends. Let's talk about what happened. The US PPI numbers came in soft, 2.7% versus the expected 3.3% year-on-year. On the surface, that sounds like a win in the fight against inflation. But then came a punch to the gut. The University of Michigan's consumer sentiment data showed the lowest reading in almost 3 years. The preliminary reading for April 2025 came in at 50.8, and it wasn't just one demographic. The drop in confidence was felt across every group, young and old, rich and poor, educated and working class. It was a broad, unanimous slump. Under normal conditions, this kind of data would send investors running into US Treasuries for safety. But instead, yields rose and bond prices dropped. That's not how the script usually plays out. That's the market whispering something deeper, something more concerning. Now, let's head across the Atlantic. While US Treasuries were sliding, German bonds were holding steady. In fact, the gap between German and US 10-year yields widened by nearly 50 basis points in just 1 week. This isn't just a yield spread, it's a sentiment shift. It signals doubt. It signals uncertainty about America's fiscal path and confidence in Europe's relative stability. And then, as if on cue, the geopolitical drama escalated. Tariffs. China didn't sit back. They matched the US, 125% tariffs on US goods. And over the weekend, they made another move. China halted the export of rare earth elements. Let that sink in for a moment. China produces nearly 90% of the world's rare earths, critical materials for smartphones, chips, memory cards, and high-tech gear. By adding strict control on the supply, they didn't just retaliate. They reminded the world how dependent we are. This wasn't just a trade war move. It was a warning shot. Markets hate surprises. They hate uncertainty even more. And this sudden flurry of tariffs, tit-for-tat escalations, and policy reversals has shaken investor confidence to the core. As a result, the US dollar has weakened sharply. The dollar index has now fallen to its lowest level since April 2022. 3 months of headline risk, back-and-forth decisions, and policy U-turns have worn everyone out. It's become too much noise, too many shocks, and investors are choosing to step aside from the drama. And these tariffs, they're much larger than anything hinted at during the presidential campaign trail. Markets don't like bad news, but they hate being caught off guard even more. There's no time to hedge, no time to rebalance, and that creates maximum impact. Add to that, the policy rollout has been confusing. Announcements come in, then get reversed within days. It sends one message, that even those at the helm aren't sure of the direction. The US also announced over the weekend that smartphones, computers, flash drives, memory cards, semiconductors, and chips will still face 20% tariffs, not 145%, as previously feared. This is because such tariffs would directly impact American tech giants like Apple. Let's shift gears for a moment and focus on Europe. British GDP grew in February, which was welcome news for the UK Chancellor, Rachel Reeves. Until September 2024, I was shorting EURGBP, and it was working. The British economy was expanding, while the Eurozone, especially Germany, the biggest European economy, was struggling to grow in both 2023 and 2024. But that changed after the British autumn budget. Both personal and corporate taxes were raised. To me, that was a fundamental shift. The fiscal environment in the UK no longer looked attractive. That's when I stopped shorting EURGBP. And now, EURGBP is still not the right time yet to play the shorting game again. With all that's happening, the euro is regaining its reputation as a safe haven currency. Germany has pledged 500 billion euro in defense spending. It's a long-term bet on stability and resilience. With an ECB rate cut expected next week, you might think the euro would weaken. But in this context, it's actually strengthening. The broader narrative is doing the heavy lifting, and I believe EURGBP still has room to move higher. Now, what about the Swiss franc? It's been on a tear lately, and naturally, there's chatter, people asking whether the Swiss National Bank will step in to slow down the appreciation. They've done it before. Remember when they set a floor of 1.2 on EUR CHF? They defended it with everything they had, until one day, they didn't. The removal of the floor sent shockwaves through the markets. Traders were wiped out, margin calls exploded, and the CNB faced massive criticism for pulling the plug without warning. Since then, they've taken a more cautious approach. Right now, the interest rate sits at 0.5%. Could they cut to zero or even negative territory again? Yes. But would they try to set another artificial floor? I don't think so. The risk of triggering another crisis is just too high. Looking ahead, the earnings season could bring some hope. Big names are reporting this week: Goldman Sachs, Bank of America, Citi, Johnson & Johnson, Taiwan Semiconductor, Netflix, American Express, and more. Strong numbers could temporarily boost market sentiment. But let's be honest, in the middle of a storm, even clear skies might not last long. So, what's the takeaway? All the signals are lining up. Investors are pulling out of the US dollar and Treasuries. They're heading toward currencies and instruments that feel safer, more predictable, and more insulated from political drama. The Swiss franc, the euro, the Japanese yen, the German bund. This isn't just a market correction. It's a narrative shift. And when sentiment moves, price follows. We'll keep tracking these shifts, and I'll keep breaking them down, right here on Markets and Global Trends.